and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, over the past 1 year, equities have run up quite a bit, and naturally, with extraordinary returns, investors are overjoyed. But at the same time, many investors are wondering if this is the time for them to liquidate their investments and book some profits. So if you are one of those investors, stay tuned, as joining us is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you.
Now, over the last 1 year, not only did the stock market recover from the crash of March 2020, it also recorded a new high. And one very common question that a lot of investors have been asking is if this is the time for them to redeem their equity investments and realize the profit. So what's your advice on this?
My advice is it entirely depends. A lot of people are getting tempted. This is the most frequently asked question. Whenever I'm faced with somebody, is it time to book profit? Should they pull their money out? Should they sell their investment? Everybody is very pleased, given that the outlook for the economy looks very grim, or people think that it is grim. Everybody thinks that it will be good to take their money out because it is just everything looks poised for some the market falling because the economy will not be doing well. But everybody has been wrong. And if somebody would have followed his instinct or his temptation 6 months ago, a year ago, or at the time of 15 months ago when the market fell very dramatically, if somebody would have taken his money out, I think one would have missed a once in a lifetime big opportunity of this game. So my suggestion is that we can all be wrong. You should do two things. One is that it should be entirely be guided by when you need the money. A few days back, on the radio show, somebody was asking me that he has collected or he has accumulated some money for his daughter's wedding, and that money is needed 3 years away from now, and he thinks that the money is good enough now for he needed all the money. So his question was, should he take the money out? Yes, if you have accumulated the money that you needed, take the money out, put the money in the fixed income. But if it is for a non-negotiable goal, if it is just that you are getting scared by this level of the market, you want to take out, I think if you need the money in the next 2-3 years, definitely take us some part of the money. Definitely sell maybe a good part of the money if you need for a non-negotiable goal. But if it is just on account of fear, then decide on an asset allocation. It could be 50% into equity, 50% into debt. It could be 75% into equity, 25% into debt, whatever you decide, and do the rebalancing so that there is a method, because we have absolutely no control on what the state of the market is. And I think we can't guess what would the state of the market will be. And going by what has happened in the last 1.5 year, we will also be mostly wrong. And the other problem of going wrong is that it will become extremely difficult to get back into the market or make the investment again once you go wrong. If you take your money out and the market has gone up by 20-30%, you just keep waiting. So it should be entirely based on your needs, and it should be entirely based on your asset allocation.
What's the harm of it? If an investor has already made, say, X% profit that he had targeted, and now he wants to redeem, why should he not sell? What should he wait for?
No one should sell. As I was saying, that if you have reached your goal, then you should sell a part of it. But if this is a long-term money, you are unlikely to need this money for 5 years and more, then decide on an asset allocation and be there. If you just want to time the market, you are just scared and you think that the market, most people are attempting to time the market. They think that if they sell, they will get an opportunity to buy things cheaper. And that is what I would dissuade people to do, keep away from. Because if it is your long-term money, all the big returns actually happen in a very brief period of time. If you miss out on some of the key days or key months, then, in the last 10, 15, 20 years, I think, the few months in which most of the returns are made, and rest of the time you just keep waiting, and you get the rewards of that waiting during that period. And that is what we have witnessed, that some of the big moves have happened. And so I would say that work on an asset allocation. Don't try to time it to invest cheaper as if the market corrects. Don't bet on that, your understanding of the level of the market.
What if the market crashes from here? It's certainly not easy to see value of your investment crashing, and specifically when you've seen it peaking. So anyone would regret in such a situation that he did not book the profits. So
No, if you need the money in next 2-3 years and if you take your money out, you will not regret. If you work on an asset allocation, assuming that even a very aggressive asset allocation of something like 75% equity, 25% into fixed income, then a market correction will translate into an opportunity for you. You will feel happy that the market has corrected, the market has fallen, because your 25% into fixed income will become something like 35-40%. You will get an opportunity to invest more from your fixed and move the money from fixed income to equity. You will be buying cheap, not dramatically, but shifting your money from, because the asset allocation, if you decide on one asset allocation, then you have a reference point. That is when you will, by way of rebalancing, you will be investing cheaper. And if you are on a 50% equity debt, then you will get a bigger opportunity, more conservative allocation. Likewise, if you are more into fixed income, less into equity, then you will get a lesser opportunity, but that's fine. So the whole idea is that you will benefit from a market correction. You will benefit from a fall in the market levels if you work on an asset allocation and then use it as an opportunity to rebalance it.
you just spoke about asset allocation. So what kind of asset allocation would you advise for different types of investors?
It entirely depends. One is that it should be 100% into fixed income if you need the money in next 2-3 years, which means that you should not be into equity. You should take your money out, move the money into fixed income. If you need the money in next, if you are unlikely to need the money for 5 years and more, then have 75% equity, 25% fixed income. You will get a lesser rebalancing opportunity, but that's fine. You will, because your money will remain invested for a long period of time. Also, it depends on how close you are to your retirement. If you are getting into a phase where you will stop earning, you'll stop contributing to your accumulation, then I think that, or you need, you are likely to need the money in 5 years or so, or start generating money for, or you there will be a need to generate income from your investment in next 5 years. That is when I would say that somebody should be 50% into equity, 50% into debt. So these are not very fine rules. These are broad thumb rules which one should follow in terms of be conservative. Use this as an opportunity to rebalance, profit from the madness in the market, and how to turn it into an advantage for yourself.
Time now to move on to the viewers' questions. The first one comes in from Virendra Gupta, who wants to know, while rebalancing the portfolio or booking profit from equity funds, should he liquidate the funds that have performed poorly or the ones that have given good returns?
If your portfolio is made up of good funds, then you should not be selling any of their losers, simply because there are times when, if you have made your portfolio well, you will find that it will be, if it is made up of say four equity fund, and 2 of them are growth fund, one is an international fund, and another is a value fund. If the value is not doing well, you should not sell it. If you're in a nutshell, if your portfolio is made up of a good fund, sell proportionately. If your portfolio has any fund which you would not like to invest anymore, that is the fund you should sell completely for rebalancing. So it entirely depends. There can also be another way of doing the rebalancing. Assuming that you have decided you have an asset allocation of 75% into equity and 25% into fixed income. Of that 75% into equity, the small cap has gone up dramatically. That small caps are like that only. For many years, they will not generate good returns, and once in a while, in a brief period of time, they will just go ballistic. And so I would say that sell proportionately, so that the spread of investment in a certain manner remains constant.
Now, Apurva Narayan says the value of his investment in a small cap fund has doubled over the last 1 year. So should he redeem and then reinvest? His portfolio has already been rebalanced and he doesn't need the money in the near future.
No, not really. He should hold the small cap and it will have its bad times. If you are still contributing to this portfolio, if you are still continuing your investments in this portfolio, carry on. The reason is that don't look at the return of your small cap fund in the last 1 year. You are getting, your money has doubled in the last 1 year because you patiently waited for in the previous 3 years. The result, the performance of your small cap fund, the dramatic performance of your small cap fund, which has gone up by 100%, is entirely because you waited in the previous 3 years when the small caps were struggling. They were actually your test of patience because they just refused to go up. So I would say, and this is very much the part of the market, different parts of the market, they do well at different point of time. It is important to have diversification across capitalization, across different styles, across different markets, which is now possible for Indian investors. So diversify well. And diversification means a very broad diversification across, ensuring that your investment is spread across different segment, different capitalization, different market. And that is why you should, if at all you have to rebalance, rebalance proportionately. As you have already rebalanced, you don't need to do anything.
Now, Vasant Shenoy wants to know, how should one proceed to invest the accumulated corpus on nearing retirement for generating regular income? He also wants your advice on health insurance.
As you get closer to your retirement, you have to first do an estimation of what is the income requirement from your investment and see it in relation to the total accumulated money, assuming that you have 1 crore of accumulated savings. And you are likely to need something like 50,000 rupees a month, which will translate into 6 lakh rupees a year, which will be 6% of the accumulated, 1 crore rupee. The way to deal with it is, you should be investing your money in a manner that after you withdraw this 6 lakh rupees, your money will, your growth, the growth in your accumulated money will still, after taking this 6 lakh rupees, will still grow to the extent that it can beat inflation or match inflation at least, so that the worth of your capital is protected. For this, there is a possibility that a 75% investment into fixed income, and the investment into fixed income could mean everything. It could be in fixed income fund, it could be senior citizen savings scheme, it could be post office MIP. So all of it combined together could be fixed income. Because some of the returns return from some of the investment vehicles will be guaranteed, which will provide you an extra comfort that all of it will not be dependent on the market. So maybe a 75% allocation to fixed income, 25% to equity, and this will ensure that the worth of your capital is protected. You will still be taking 5 lakh rupees because you have another need that today you might need 50,000 rupees a month, which is 6 lakh rupees a year. 2-3 years from now, you might need 60,000 rupees a month with rising inflation. So with that in mind, that is why you must have this equity allocation. Now, coming to your health insurance need, we really have dearth of the long-term care insurance as you get into, as more and more Indians live longer, and the need for healthcare has been extended. As we are going, greater longevity. And there could be need for long-term care, which many of these healthcare schemes don't provide. But there is a there is a talk. The insurance regulator is nudging insurance companies, general insurance companies, to provide long-term care health insurance. And let's wait for that. But as of now, the options available. Very soon we will have a report on Value Research, which will give you the best health insurance for different kind of background, because health insurance, choosing the health insurance could be complicated. It is not an investment. You have to do this careful spending on health insurance, because what are the kind of exceptions being made? If you have, and there is one more thing which one should look at. Many of the term insurance, many of the life insurance that you buy, they also come with a rider of any critical illness, so that something happens to you, any of those stated critical illness, you will be getting something like 10 lakh rupees or 15 lakh rupees on that account. They are very useful, because term insurance is when your The beneficiaries, your dependents, will get the money. But here is something where which will impair your ability to earn, or your need for spending your healthcare might go up dramatically. And that is when this term insurance riders come in very handy. So maybe consider adding those critical illness rider carefully into your term insurance. Maybe it can be added to term insurance offered by many insurance companies. They provide, there is a provision of having an additional rider being added to scheme, and that plan, and you pay extra for that. Health insurance, we will soon have a report on Value Research which will give you all the nuances of what is your health condition, what is the different background, and the suitability of different health insurance plan for different people.
The next question has been sent in by Charan Kumar, and he asks, what are the key parameters to consider while investing in debt funds?
Broadly, two things. One is the credit quality of the fund, which means the kind of bonds the fund has invested in. And this is the information which is very easily available on Value Research, and it is updated. And it is updated every fortnight now, because that is what SEBI has mandated every fund company to. The other is, the maturity. How sensitive is the fund to the interest rate changes? If the fund has a very long bonds, if it is holding bonds which will mature in 5 years, 10 years, 15 years, 20 years, then if there is a small change in the interest rate, the fund value can change dramatically. If the fund is holding those long maturity bonds and interest rates go up, these bonds will go down in value very sharply. If interest rates go down, then these funds holding long bonds will go up very, very sharply. So the sensitivity to the interest rate and the quality of the bonds, and the quality of the bond is entirely a view based, the credit rating agency's view on the likelihood of the bond issuers paying the principal and interest on time. And so these are the only two critical things. So if you want less risk, look for higher allocation to the top rated, which means the government bonds and the AAA rated bonds. And if you want less sensitivity to the interest rates, then you should look at lower maturity. And SEBI has also come up with, has mandated, every bond fund will come up with a 9 matrix, something like mutual fund style box that you find on Value Research online. Now SEBI has mandated fund companies to officially put that and revise it every month. So you will get this information also from fund company, besides looking at things where we have been doing it for nearly 20 years. But now what we have been providing you for 20 years, now that has been made, a law has been made by SEBI for every fund company to comply with.
Virendra Kumar Arora wants to know if debt funds have the facility of systematic withdrawals, and if yes, what are the income tax implications?
Yes, systematic withdrawal plans are very much possible from debt funds as well. It is a generic, feature available with most funds, except for, tax saving fund where your money gets locked in for 3 years. And the tax treatment is same as any debt fund, which is if your redemption is of units, and by redeeming units, the principle of first in, first out is followed, which means that if a part of your investment is more than 3 year old, so those investments which are more than 3 year old will be treated as long-term capital gains, and capital gains tax is applicable after adjusting your capital gain by the inflation index. So your returns after adjusting for the inflation, only that is taxed, and that too at 20% tax rate. So, and if it is less than 3 year old, if you invest money today and start pulling money out tomorrow, then there will be very nominal gain, but effectively you will be taking a good part of your money, good part of your principal tax wise. I would say that your whole money is growing, and even if you are taking that return, it will be, the tax treatment will be very concessional, simply because all your money is generating return like fixed income. But in the initial months and years, it will look like as if you are consuming your capital, which is very tax efficient. So though it will be treated as income, it will be added to your income, but your income component of the withdrawal from the fixed income fund will be very small.
Now, Ashok Kumar Sangal asks, is it advisable to invest in commodities fund?
It is advisable in a sense that, recently commodity funds have done well, but, we don't have too many pre-stated, well-defined commodities fund. And the commodity fund which I am referring to are the mutual funds which invest in the shares of the commodity companies. So commodity companies will be, the metal companies, oil companies, commodity is being referred as a commodity where the manufacturer or the producer of that commodity, they don't have the pricing power, so it is entirely dependent, and so that is why they turn out to be very cyclical. It depends on, there will be a steel cycle, there will be a metal cycle, there will be an aluminum cycle. Suddenly, after 7-8 years, 10 years of slumber or poor performance, the steel industry is beginning to do well, and that is what we find. So that is what we find in the Tata Steels in the market, or Nalco in the market. So you will have companies which are commodity producers, and they start doing well, and that is the only way for investors to invest. We don't have mutual funds which invest in commodities directly.
AVK Durga Prasad Durga Sharda wants to know if beginning to invest in NPS at the age of 46 is a viable option.
Oh, it's an important, it's not only viable, it's, tax efficient too. If you are, the 50,000 over and above HTC is something which is very important. You should do it. And if you are able to persuade your employer to contribute in NPS in line with, if they allow you to structure the salary in a manner that the NPS contribution is made by your employer as part of your CTC, cost to company calculation, then it will be very beneficial, because the part of the part of your income which is contributed by your employer in the NPS will be tax free, and it is actually a deferred tax, or tax free from your point of view, and on your retirement it will become your asset. So it will be a very interesting option. It is very useful if you are able to persuade your anybody who is able to persuade their employer to contribute to NPS to the extent possible, and that is deducted from your income for computing taxes.
All right, now Deepak Shah has sent in the next query. He asks, which mutual fund category is good for a 54-year-old who wants to invest for regular monthly income?
If you want to keep it simple, the conservative hybrid fund, they typically have 20-25% into equity, remaining in fixed income, and you don't have to worry about the asset allocation or rebalancing. Everything happens at the fund's end, and investing here, but invest in the growth option, and do a systematic withdrawal plan from this investment. That will keep it easier and also tax efficient.
Ali Akhtar has been investing in PPF for 5 years now. If the interest rate goes down further, would you suggest continuing with it, or should he invest in a debt fund instead?
I would like to, tell Ali that if interest rates go down, the return on everything will come down. It is not that PPF, the return on PPF will go down in isolation, and the bond funds will generate more return, or equity will generate more return. My sense is that, if interest rates go down because inflation has gone down, so the interest on bond funds, or because the bond will also go down, and even the equity returns will come down, because everything works very much in tandem with the base interest rates, but our effective return, inflation adjusted return, will be still be okay. So my general suggestion to him will be that if you are my general suggestion to anybody who is beginning to invest in PPF is that you should not invest in PPF, because PPF is something like 15-year fixed income SIP. So 15-year term fixed income SIP one should not do. One should invest in equity, because I'm confident that equity is any SIP for 15 years of a constant amount as compared to PPF will always be substantially higher. The return on that will be substantially higher. But my other advice is that if you have done the accumulation in PPF, don't take your money out, because if you have for some reason done it and the money has become meaningful, because the return on PPF is completely tax free. You can keep and there is no other fixed income avenue where it will remain tax free. So maybe I will be sounding quite confusing that on one hand I'm saying that don't invest in PPF, on the other hand I'm saying that if you have invested in PPF, then don't take your money out. It is for the reason that every investor should look at PPF as a fixed income allocation. If you have accumulated, consider that as a fixed income allocation, and there is no better way that there is no safer avenue and tax efficient avenue as compared to return from PPF. I might sound confusing, but for higher return, for your discipline and regular investment in PPF, consider an equity fund for 15-year term. That is what you do in a PPF.
Now, Durgesh Kinarkar has sent in today's last question. He wants to know if it's a good strategy to do SIP in direct equity stocks. How is it different from an SIP in mutual funds?
Conceptually, it is the same, because you invest in why I suggest SIP in equity fund is the same reason why you should be investing in even shares in a staggered way, because we are not very sure. You can choose a good company, but you don't know if it is the best price. So spreading your investments over time reduces risk, reduces anxiety, but it is not the same as investing in mutual fund. Investing in mutual funds, you have one benefit and one disadvantage. One benefit is that it provides you the convenience and a professional management. You know that, okay, you are putting your 5,000 rupees, 2,000 rupees money, and it gets into a mutual fund, and you remain there. Whatever the fund manager does, your tax implication will be on your holding period. If you put your money and you take your money out 20 years from now, the gains will be applicable on the money invested and the money realized, and it has nothing to do with what the fund manager has done with your money, sold it 10 times during the year or whatever. He might be generating short-term gains, long-term gains. It is none of your business. As compared to that, investing in a share, you will have to keep an eye on it. You have to, you might do a SIP, but there is a need for selling, the stocks. You have to keep an eye on what has become very expensive, what is no longer a good stock, what has become more attractive today, what to buy, what to sell. So that requires, some degree of active involvement. So if you have the time, if you have the inclination, and if you have the temperament, because and if you can do these things well, and if you enjoy doing it, go for the shares, go for your SIP in equities, shares directly. Otherwise, entrust your money in a mutual fund. And also, for 2,000 rupees, 5,000 rupees, 10,000 rupees, it may not be worthwhile to be an active investor. So I would say that, there is a hierarchy based on your experience, which every investor should follow. One is that if you have never done any market-linked investments and you are investing, I'm assuming that this hierarchy is meant for any long-term investor. Long-term investor meaning investing for 10 years and maybe investing for 20, 30, 40 years. Everybody should start with a balanced fund or a tax-saving fund, because you get stuck for 3 years. So if you are a taxpayer, invest in a tax-saving fund or a balanced fund. Do it for 1 or 2 years, so you will understand and you will reconcile with the volatility. Then comes, invest in an equity fund, 2, 3, and move all the money that you have accumulated in balanced fund or anything, and move that money into 2, 3, a diversified equity fund, aggressive fund, and continue your investment for another 2, 3 years. So after 5 years, if you think that you can reconcile with the ups and downs of the market, you enjoy reading the annual report of a company, you have enjoyed, you have understood how to choose a good stock, and you have the temperament of, investing in a stock even while it is going down because you have the belief, or you're able to spot an opportunity where you hold a stock and things are going wrong and you'll be able to sell it. These are the skills. These are the this is the understanding which an investor requires. So after 5 years of doing with your balanced fund and your equity fund, one should consider that. And also don't do it at one go. Maybe, move your 20% money, 25% money into equity, all the accumulation in the equity fund into equities directly. Try it out for 1 year, then take it to 50%, then take it to 75%. So this will be a methodical way of learning equity investment firsthand with your own money. And then there will be advantage of this. The advantage will be that you will also, all the service that you get from a mutual fund, the convenience, professional management, and all that, you should be, you will be able to, you get it for the management fee. There will be two rewards. One, you will save on the management fee, and you will start enjoying investing in stocks, shares directly. So this is a 5-7 years plan. I don't think you should do it in a hurry, and don't get attracted to the market for making quick buck, because if you are able to, attracted to the market because easy money is being made, people lose money as easily there too. And one more thing, of late, a lot of investors are getting attracted to the stock market because it's going up. It's just refusing to go down, and more and more people. And investing in share has become frictionless. You can go to a Zerodha, Grow, Paytm Money, and start investing tomorrow, and they don't charge you the transaction fee for your delivery transactions. But the charm is that they are basically looking forward to you becoming a speculator with the futures and options, the derivatives. Don't do that. It's a very risky thing. What the old man, the Warren Buffett, everybody quotes him that they are instrument of mass destruction. They are very risky. It is like having a leverage trade. So easy money is being made, and so is easy losses. A lot of people have not experienced that. Don't get attracted to it, or if at all you get attracted to it, try it out with a very small sum so that you understand the nuances of it, and you understand that it is not that easy. It is very complicated, and it is entirely dependent on your luck, or reasonably dependent on your luck than skill or understanding.
All right, then don't get attracted to make quick bucks in the market. If you're there, stay there, think well before you do that. And with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you, Ruchira.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Bye for now.